Hello and welcome to Business on the Wire. He was India's youngest Deputy RBI Governor post-economic liberalisation. But in a somewhat shock move in 2019, both the RBI Governor Urjit Patel and the Deputy Governor Dr Viral Acharya decided to step down from their position well ahead of their tenure ending. There were signs that there was a rift between the Reserve Bank governors and indeed what the Finance Ministry wanted to push through. In his recently released book, that's exactly what Dr. Viral Acharya has touched upon, as also what looks to be an escalating banking crisis. The book is entitled The Quest for Restoring Financial Stability in India, and joining me to talk about all of that is the author himself, Dr. Viral Acharya. Thank you so much for joining in and talking to me about your book. Before we talk about what you've mentioned and the things you've alluded to in your book, I want to sort of press the rewind button, Dr. Acharya, and go back to October 2018, when you stepped up to make the speech that you did and made the points that you did. Did you foresee the cataclysmic reaction that followed within the media, within financial circles of the points that you raised?
Absolutely. At some level, I think it was a fairly important resistance that the central bank was putting up. As I describe in the chapter Fiscal Dominance, a theory of everything in India, that we were still trying to clean up from the credit excesses of the last decade. And in the midst of all that, it seemed that we were reversing the gains and there were pressures on to actually repeat some of those mistakes all over again. As I stressed in the A.D. Shroff Memorial Lecture, the tension is very clear. The government horizons for decision making can become very, very short term at certain points of the political cycle, whereas the central bank is charged in its objectives with very long term goals that you just can't achieve over a short period of time, like safety of depositors, inflation stability, external sector stability, and so on. So we did expect a reaction, but I was also very clear that if these pressures are being put and certain parts of the RBI Act are being invoked as being in public interest, then we should have a public debate about these issues. Let the issues be out in the open, because that's the only way. I think in a way you can have democratic accountability of the decisions, because it was never explained and fully clearly what the public interest was. And it was not clear to us that this was necessarily in the long run public interest. So I think we had to put up the defenses, the resistance. As I keep saying, it did come at a professional cost to us. But we thought that was the option on the table we had left, and we had to do it. We expected the reaction, but in a way, that was not the important point. I think the important point was that we needed to have a public debate about these issues, and hopefully it raises some of the deeper imbalances that are causing this public debate. If I could just add one more thing, Mitali, there, which is, Dr. Reddy points this out in the foreword of the book, that disagreements of this type have always been there. It's all over the world that the government's horizons become short term. Even in the developed countries, as we are seeing, that's the case. The pressures are there on the central banks. But the central banks have institutional arrangements in many parts of the world to be able to say no, to resist the pressures. Dr. Reddy clarifies that in the letter of the law, the RBI Act is actually one of the weakest in terms of protecting the central bank autonomy. What has happened over time is that in functioning, RBI did not actually face as much pressures. And it was because, there weren't reasons for there to be too much pressure in the first place. He refers to the government, the central bank and the public sector banks being this Hindu undivided family where no one kept anyone's accounts. But that is not the situation anymore. We have a private sector, we have markets in the economy, And therefore, some of these tensions are rising now. And I think, especially post the global financial crisis, the growth has not been as easy to achieve as it was before. The government balances have gradually been slipping, other than the few years when there was a massive collapse of oil prices. And the household savings rates in India have also been coming down, making it hard for the government to keep slipping and yet not have an impact on its borrowing costs. And therefore, the tendency then is to go to the central bank and lean on it to use whatever levers are there to keep its borrowing costs low, get the banks to lend so that short-term growth impulses can be created, and so on. So I think it's a complex situation in many ways, but I think it is possible to diagnose what the root causes are. And I think we can put in place institutional reforms on the fiscal side as well as on the financial stability side to safeguard and strengthen the system going forward.
Let me go, forward then to your book and the points that you have raised there, Dr. Acharya. One of which is, you talk about how banking sector stress in India tends to play out somewhat silently. Given what has gone down in the last couple of years, and given what we might expect to see post this pandemic, and what washes ashore, would you say it is that silent anymore?
It is, I would say, still silent as far as the public sector banks is concerned. They are seeing an attrition of their deposit base, actually. This is a point that many credit analysts have been making, that earlier we thought that only the credit share was shifting over to private sector banks. But what they are showing is that increasingly, even the new deposit creation is actually occurring far more with the private sector banks. But as far as public sector banks are concerned, there is still the sovereign guarantee, and therefore I would say it is still playing out slowly and silently. I like to call it a slow run, so to speak. The depositors are not sort of running by rushing to the ATMs, but it's like a very gradual reduction in that. Part of it is just the quality of services, I think, that are being provided. Like I have spoken to some of the staff that was working for us at our home, and they were complaining about the quality of services that they were getting on their checking accounts and so on at some of these banks, because I think they are really strapped, I think, for procedural efficiency, quality of human capital. And sometimes, the branches don't have as many people as they would like, and so on. So I think it's a real problem. Now, but I think coming to your other part of your question, which is, are all aspects of the banking stress playing out silently? Surely not, because in private institutions, it won't play out silently, because the implicit strength of the sovereign guarantee is not perceived to be as powerful in case of a private bank. In fact, some of my research after the global financial crisis also showed this happen, which is that once we had the Lehman Brothers collapse, actually there was a massive flood of deposits that came out of private banks and moved into public sector banks. In fact, one of the large Indian companies went to the newspaper and said that, listen, our money is with a public sector bank and not with a private bank. And in that sense, the private banks will always be at somewhat of a disadvantage. But what is very interesting is that since the global financial crisis, private banks have actually maintained far higher capital levels. Even right now in the COVID phase, they have gone to the market and started raising capital on their own. Because they are anticipating the losses to come. They know that in their case, stress will not play out silently and slowly. Stress will play out a little more violently, as we have seen in some cases. And so they are already creating private deposit insurance, so to speak, by raising capital. Final point, Mitali, is that private systems do fail. But my assessment is that these have been somewhat more idiosyncratic failures of governance in some cases. And in certain parts, there was an excess gush of liquidity, as in the case of the non-bank finance companies. But I think the central bank has taken corrective measures to ensure that even the non-bank finance companies are holding more liquid assets going forward. So hopefully the private system should, through its own actions as well as the central bank's regulatory actions, be able to withstand the stress and the pressures. Nevertheless, I think what the central bank can do is to use the stress tests which are disclosed in the financial stability report and proactively ask everyone to raise capital across board, in my view.
So I want to come to NBFC separately as a category of discussion, but I think the point one is focusing on right now in the banking system, aside from infrastructure issues, is what's happening with bad loans. The RBI's recent survey itself that was conducted paints a worst case scenario of 14%, which is close to doubling of where the rate is at right now. Do you think they are being conservative, as the RBI usually is? Do you think it's going to be much worse, or do you think it's we might get away with something lesser?
So I haven't done, sitting outside the central bank, it's hard to do the kind of stress tests that a central bank does, because a regulator, supervisor has access to very granular data on bank balance sheets that an outsider would not. But I think at a minimum, one has to take that stress test very, very seriously. And require that the system at least hold capital to be withstand that kind of stress. See, clearly that aggregate number has granular details of which bank is likely to experience what kind of shock in different scenarios. And I think even though we don't see full public disclosure of that granularity, clearly inside the Reserve Bank that is known, and therefore they can engage with the bankers and ensure that the balance sheet capacity is restored in a proactive manner to deal with this. Now, at NYU Stern, after the global financial crisis, we do calculate a market-based information-driven capital requirement. And our assessment is that since January, February, there has been an increase in the capital requirement for banks. This would be on the order of an extra capital requirement just because of the COVID shock. That is on the order of $15 to $20 billion. So I think these are non-trivial amounts, and therefore the sooner we start to getting banks to raise this capital, the better it is.
Mm-hmm. I want to draw you back to the ILNFS episode, Dr. Acharya, and you write about that as well, where you say the RBI's decision to not offer substantial regulatory forbearance and emergency funding had support from some parts of the government, but not others. And I think it was almost like a critical tipping point for the Indian economy, where many people point to the fact that ILNFS should not have been allowed to keel over the way it did, and that really set off a cycle of more miseries for the entire space.
Of course, there is differing assessments on this, Mitali.
What's your assessment?
Yeah. I think I've sort of hinted at it in those 2 pages of the chapter. My assessment is that demonetization caused a huge wave of formalization of the savings. So we had a lot of deposits that got created in banks. At that time, banks were not very healthy. The recap, etc., had not happened. So they were not in a capacity to lend. So actually, the gush of deposits became a problem because deposits are actually costly to serve. Yeah. And so, the deposit rates fell for the savers, and the Indian savers started looking for higher yield, saying, I'm not getting much on the deposits. Where can I get? And then, usually the shadow banking in such times when there's a search for yield starts developing innovative products to attract the savings to itself. So we saw this debt liquid mutual funds actually grow in a very large amount that time. And in fact, we studied and found that non-bank financial companies had increased their reliance on short-term commercial paper. So they were usually reliant on long-term NCDs, non-convertible debentures. So these are long-term bonds. Instead, they moved 50% of their reliance on average, especially in housing finance, to very short-term credit because it was so cheaply available through these debt liquid mutual funds. Now, when you get such a huge gush of liquidity at a very low cost and at short maturity, usually, as we saw even at the time of global financial crisis, that short-term cheap funding for the financial sector has a tendency to be associated many times with poor underwriting standards. And in fact, ILFS problem was not an isolated problem. We found very quickly that there was actually a triumvirate that was kind of involved in this. There was actually likely some evergreening of poor quality infra and housing loans that was taking place at that time. So there were other institutions that had also benefited besides ILFS from this gush of liquidity into the debt liquid mutual funds. And it was not clear whether central bank providing support to these institutions directly would have meant throwing money after the good. So it's just that loans are good, and for some reason there is a panic in the market, or is it that they have genuinely actually made bad loans? They have evergreened their loans, perhaps created shell companies and siphoned off some of these funds. There were reports with analysts in the financial sector. I have students from my past teaching who are all working in India in different parts of the financial sector. I spoke to them. Many of them were giving advice to short selling institutions. Some of them were equity analysts. Some of them were credit analysts. And they were all of the opinion collectively that, listen, on the ground, actually, these balance sheets are not that great. Now, a central bank is supposed to address liquidity problems. And the central bank did provide massive amounts of aggregate liquidity to the system. It has always been done through the banks in case of the Reserve Bank of India, until recently when it has directly provided liquidity to corporate bonds and so on. But massive amounts of liquidity was injected into the financial system at that time. But the key to realize is that a central bank cannot use liquidity to solve solvency problems. If an entity in the end has made bad loans and is effectively insolvent relative to the debts that it has taken on, then it's going to require financial restructuring. We can't just keep bailing out all of our institutions one after the other. And the second point, which is also equally important, Mitali, is that there's a reason why the non-bank financial companies are not banks. They are not required to meet very important restrictions, such as maintaining a pool of liquid assets as large as banks are required to hold, for example. And the idea is always that if there is stress, then it's supposed to play out on its own. So it's not that this is just one way. It's a quid pro quo, which is that we won't charge you dramatic prudential requirements which we impose on banks because they have deposits and you don't, but we will require that you deal with your problems on your own. I still stress that the view was that the central bank should be lender of last resort, not a lender of first resort. The central bank did inject actually massive quantities of liquidity into the system, and I think the final point I would make, which is in a footnote in the chapter, is that personally, I would have liked if an asset quality review of the non-bank financial companies was undertaken and actually its results were made public as to which entities are healthy and which ones are not, because that would have reduced the generalized risk aversion towards the entire sector, because the central bank would have been able to separate the pool of the healthy NBFCs from the not so healthy NBFCs, and then the not so healthy NBFCs could have over a period of time been restored to better health through a variety of corrective measures that I suggest.
So you're saying at that point in time, Dr. Acharya, there was no asset quality review, which we know. Much of this stress was visible for anyone who's looking at balance sheets, and not a lot of this was hidden from the public. There were people taking trading decisions based on what they were seeing on balance sheet rot.
Yes, absolutely. In fact, it was not the case that the markets didn't know that these institutions did not have problems. They knew, and in a way, the problems
was the question I wanted to ask you, was how many entities were turning a blind eye to this situation at that point?
Yeah, I think, I think what happens with a gush of liquidity of the type that we saw post demonetization into the debt liquid funds is that very invariably it starts combining with other forces to create more and more credit origination, because there's so much money chasing, and everyone wants to get their sort of fee-based commissions out of it. So underwriting standards go for a toss. The system as a whole starts weakening in its credit standards at that point. Just to be clear, Mitali, I'm not saying that an asset quality review was not done. What I meant to say was that an asset quality review could be done and be made public.
Public, yeah.
Yeah, I think that's the difference. I think clearly the central bank has gone on record saying that we are actually doing internal assessments and diligences. If you look at the US stress tests after the global financial crisis of 2009, what really brought the uncertainty about the financial sector down was that the Federal Reserve said that these are the 19 largest banks. 10 of these are fine, 9 seem not so fine. The 9 that are not so fine, this is the amount of capital that they need to raise, and they have to raise it by end of June 2009. And that gave confidence to the market that no, these entities are fine, and even the ones that are not fine, there is a time-bound, credible plan to actually get them back into shape. So I think that is the missing piece in my view, which is that we are not credibly sending a message as to how are we shoring up capital on the balance sheets of NBFC sector as a whole, so that repeatedly we don't have to ask the question whether it is healthy or not.
And that would only happen with fear of retribution or serious action, right, Dr. Acharya? So on the one hand, there are parties who are playing the game and turning a blind eye to it. There's the Reserve Bank, which, as you pointed out, was doing what its mandate was. What was happening in the finance ministry?
I think, that's not the room where I was sitting. So I really don't know.
But I think you were interacting with them. What was the feedback when the situation was laid out on the table?
I think as I explained in the chapter, there were pressures on us to open the liquidity taps at that point of time. And our view was that liquidity provision should be aggregate and it should not be targeted to specific entities. RBI has always achieved that through the banking system by getting the banks to actually on-lend to the NBFCs. Because, see, credit assessment has to take place at the end of the day. And essentially, the arrangement that the RBI adopts is to say, listen, the lender of last resort will be with the banks. The banks can then do on-lending to the NBFCs based on their assessment of the credit quality of these entities.
One of the protagonists from that side of the table, the chief economic advisor, has gone on to say more recently that the problems in the banking sector are the main reasons for the economic slowdown, and the economy is caught in a chakravyuh caused by bad decisions. Who do you think he holds responsible for this situation?
No, I think it's probably best to get him to elaborate. So I don't want to sort of interpret his remarks very specifically, but I think if I could divert attention a little bit to what I'm trying to diagnose and propose in the book, is that I think this idea that the banking sector problems in India are separate from India's fiscal problems, I think this needs to be fundamentally questioned.
Yeah.
I think that is the deeper point I'm trying to make, which is that the presence of public ownership in banks, insurance, and other parts of our financial system, the fiscal stretch that is there, and the pressures that are on the central bank all the time in a pervasive manner to accommodate growth considerations through a variety of relaxations. At a minimum, we need to have a debate about this issue, I think, because it could be that the cause is somewhere else and we are trying to fix symptoms rather than actually address the deeper cause of the malady.
I was speaking with the former Reserve Bank Governor, Mr. Subbu Rao, last week, and he made the point that this is something he actually fought vehemently earlier, but he felt that perhaps the time for a bad bank experiment had come. Would you agree with that observation?
I've also gone on record actually prior to joining at RBI that maybe a bad bank should be on the table. It was a decisive way to get bad assets out of the system for many countries in Southeast Asia after the Southeast Asian crisis. Most recently, Ireland, after its housing crisis in 2008, also actually adopted a national asset management company of housing assets to clean up the banks. I think in the Indian context, two questions keep coming up. One is that typically when we set up new institutions, they don't take off ground that quickly in terms of their mandate being set up, funding being allocated to it, right people being found in order to manage the institution, etc. So some people have been concerned that setting up a bad bank will take the bad assets out of banks, put it into the bad bank, but then these assets will not fundamentally get resolved. Now, if that doesn't happen, you don't actually fix the underlying corporate sector issues because the indebtedness is still there because you have taken these things out of banks, but you are not addressing the firms themselves. The second issue that arises is, okay, you'll take these assets out of banks, put them into the bad bank. Clearly, you won't do them at full prices. So, banks will have to make write-offs when these assets are sold to the bad bank. Will banks be recapitalized for these losses? Will the losses be recognized? And will banks be recapitalized in time when the bad bank is formed? Because if you don't do that, then there's no difference between the assets sitting on the balance sheet or off balance sheet, because ultimately the bank needs to be healthy. It needs to have growth capital. It needs to have capital enough to know that if they take risks, they have the capacity to withstand it. And also they need to have capital enough so that they don't keep throwing it after the bad. Instead, they say, let's now use it to bring the balance sheet back to a sign of health. So I think what I'm trying to say is that the mechanics of the bad bank need to be worked out and spelled out fully. And I think it would be a huge contribution if someone can explain very clearly how these structures would work. But second, whatever we do, whether we do it through IBC or whether we do it through a bad bank, there will be a recap bill that's associated with it. And I think we need to arrange funds for that.
Dr. Acharya, I take your point about deeper thinking and soul searching, about how to fix the banking side of things, how to fix the infrastructure side of things. I think the circumspection comes from having watched the track record of the finance ministry over the last couple of quarters. What is also a bit disillusioning is the fact that many people who join in positions or advisory positions or otherwise such as yours make early exits, which seems to indicate that all is not well, things are not functioning perhaps democratically if nothing else. And one is left with the feeling that this is not a ship that is being prevented from sinking. It may be slow, as you said, it may be silent as well, but sinking it is.
I have to say policy making is not easy. You get hit by shocks all the time. COVID is a very large shock, and no one would want to be dealing with a pandemic, frankly. So I think we should not underestimate the challenges that we face. Sometimes, of course, we have allowed imbalances to keep escalating and accumulating, and then progressively the situation becomes harder and harder to wrestle and grapple with. But I tend to think that you have to fight whatever the situation is at a given point of time. It requires constructive debate. It requires open dialogue. It requires entertaining different options, seeking out whatever expertise there is in the field. I think it can be done, and I'm very hopeful that we do it and that we get on to a more stable and better path for the long run. What I'm trying to say is that I think we should focus on the core issues and the solutions. Then the debate and the dialogue remains constructive, and we can keep moving forward. And I think it's great that people trained abroad have been able to come back and get the opportunity to serve. I think they've all contributed in their own ways to raising the level of the public debate, tried their bit, and maybe other people will come and keep doing it, I think. So I think it's never too late to correct. I think we have the right demographics. We are a very hardworking set of people. I think the aspiration is very high. What has really changed in the last 10, 15 years, in my view, is that when you go to an IIT or an IIM, the entrepreneurship that's in the youth, and they're wanting to just go ahead and do and put in place ideas that are in their mind in venture firms, etc., is very refreshing. And I think this is a change, and I think it needs to be nurtured. We need to ensure that the rest of the ecosystem is right for them to thrive and take us to greater heights. So I see the spirit of my book, as critical as it might seem, as one of, I think, a constructive debate that can take us forward.
I appreciate your balanced and diplomatic response to that. So one final question to you on how you're reading the reaction of the capital markets in the last couple of months. I know that in your previous speech, you did sort of refer to the fact that any misstep will draw the wrath of the capital markets, but they've been a misnomer. I mean, the economy is moving in one direction and the capital markets in another. How do you read that? Are the two going to converge at some point, or is something else playing out in terms of dynamics?
That's a great question, Mitali. The central banks have been accommodating growth weaknesses all over the world with very massive, unprecedented stimuli. The growth in balance sheets of systemically important central banks in US, Japan, Eurozone, Bank of England is really very, very large. So there's just a lot of slush funds in the global system. It's earning very little interest rates inside these advanced economies. They can afford to do that because their inflation rates are very, very low. And a lot of that is chasing relatively faster growing or with potential to grow faster economies such as India. That has helped. Of course, there has been significant domestic accommodation that the central bank has also undertaken in a variety of ways. And because the interest rates are so low in India as well, even the Indian saver is actually turning to equity markets. Historically, we used to, if real rates were very low, we used to end up turning to real estate and gold. But with the financialization, the funds that are going into SIP, more and more money has been going into the domestic equity markets as well. And if I could use this to make one last point, Mitali, on this, is that therefore the equity market conditions, in my view, are relatively benign, as you say, compared to the anticipated macro outcomes. And I think this is a golden opportunity not to be wasted for shoring up the capital of the banking sector and the non-banking sector. I think they can go to the market. See, they've been given a support. They've been accommodated in a variety of ways, as we discussed. So the good thing to do would be to use that relief that's been provided to the financial sector to now use that time, use this stopgap arrangement to actually strengthen them for the long term, raise capital, divest stakes in public sector banks, get private banks. I think the large ones are already raising capital, get even smaller private banks to raise capital, get NBFCs to raise capital. I think this would be a tremendous use of the relative calm that we see in the markets as of now.
It's been fantastic chatting with you. Thank you so much for joining in. All the best with your book and, of course, your teaching stint. I hope to keep in touch as well. Thank you, Dr. Acharya.
Thank you, Mitali. Thank you for the opportunity. All the best.
To receive instant updates on all videos from The Wire, click the subscribe button and hit the bell icon. Pay to support independent journalism. Click the link in the description and choose the amount you want to pay.